Derek Izuel, Chief Investment Officer at Shelton Capital Management, is here. Let's talk stocks now on the Money Life Market Call. Welcome to the Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they put it all together. And putting it all together for us today, Derek Izuel. He's Chief Investment Officer at Shelton Capital Management, where he's Portfolio Manager for Shelton International Select Equity, that's SISLX, and also Shelton Emerging Markets, EMSLX. Want to learn more about the firm and its funds? SheltonCap.com. Derek Izuel, welcome back to Money Life.
Always a pleasure, Chuck. Thanks for having me on.
We always start with methodology, and at Shelton, you guys have one that you really are dedicated to. Explain how it works.
Sure. So at Shelton Capital, particularly for these funds and the other strategies that my team manages, we are really focused on putting the right stocks in the portfolio and then managing the risk around those. So we don't make big bets on, which part of the world is going to perform or which sectors or industries. What we wanted to make sure is that we get the right companies from all those different areas into the portfolio and generate our performance from that. The real indicators we use and criteria that we focus on for picking stocks are data and information that comes from sources of insight, areas or places that know a little bit about what's going to go on in the future for a certain company. There's ways that we will analyze the communications that management has. We'll look at what the investor base looks like and what they know about these firms. And also we look at a lot of analyst data because there are certain data points that Wall Street analysts provide that are really valuable. There are some that are not, but we focus on the ones that we found give us the best indication of where that stock's going to go in the future.
So that's basically a bottoms-up approach, but if you're putting together a portfolio where you find the right stocks, but you manage for risk, where the top-down stuff comes in is that managing for risk part, right? It's the, let's find the right business. We could hold it forever, but the reasons we don't have to do more with conditions, whether it's industry or global world, et cetera, right?
Exactly. So we might say, gosh, there's a lot of really interesting semiconductor companies, but you know what? We already own 5 of them. That's probably enough, because if the cycle turns, then the semiconductors as a whole will get beat up. So, and regardless of how good our semiconductor companies are, we're probably going to suffer a bit there. So we try and balance that out. We're really interested in some of our international products in Japan, and we're overweight Japan, but we limit that a little bit because, you could get a decline in the yen or something that's related to a macro event, and thus beat up all our Japanese stocks, even though they might be the right ones to hold.
Interesting. And in this market, I'm curious because we've had some folks talking about international. On the one hand, you don't want to be overweight Japan. Are you, and I realize you run an emerging markets fund, but where are you on emerging markets versus developed and the rest at this point?
Well, I think it's a great time for emerging markets, and there are many different reasons. I'll try and focus on some of the most important ones. But first of all, they're cheap. Emerging markets over the past, call it 10 to 15 years, really haven't gone anywhere. The S&P is up, it's probably tripled in that time period. Emerging markets are up like 1% per year. So that relative valuation is really, really wide. Now that's great, but you could have said that a couple of years ago, and 3 years later, you'd still be underperforming. Why do you think we necessarily think it's time? First of all, they've really done a nice job of managing their economies. There's a lot less debt in the emerging markets now than there used to be, and maybe you could argue a lot less debt than there are in developed markets. So that provides a nice base for them. They're not nearly as risky as they used to be. And a key catalyst to making emerging markets perform will be the dollar. The dollar has been very strong over this time period where the S&P has outperformed EM. We're starting to see it top out a bit. It really peaked about a year ago. It's been a little soft since then. And if the interest rate dynamics of the world continue, particularly relates to Japan and the US, and the dollar starts to weaken, that could be the catalyst that makes emerging markets really start to perform. That was the catalyst that triggered emerging markets the last time they had a long period of outperformance, which was back in the early part of this century, like 2000 to 2008, when the dollar was weak and EM outperformed.
Obviously, you run international and emerging markets funds, but you're also running funds that own domestics. Given where we are with global currencies and everything else, is there more of a case to have boots on the ground, or do you want to, are you perfectly okay getting international exposure? And I recognize not in the international and emerging markets funds, which have a mandate to be there, but for my audience where they could be thinking, okay, I'm good with getting more emerging markets exposure, but I want it in, US based multinationals.
Well, that's a great argument, Chuck, and a big topic that's often in conversation about, well, why don't I buy Clorox? Half of their sales are overseas in emerging markets. I don't know if that's the number, but that goes on and on with a lot of big U.S. multinational companies. Is a considerable portion of their sales and their growth is in emerging markets. How about I get my exposure that way? That's great, but within the markets and the way that stocks perform, it is really where the company is located still really drives most of the country-related and geographically related performance. So if you want to get EM exposure, you actually got to buy EM stocks. Your Procter & Gamble's, your Coca-Cola's, your Microsoft's, they're still tied to the U.S. market. And the macroeconomic forces that are moving the U.S. market around are going to affect their stock price, regardless of how much business they're actually doing overseas.
Well, now let's get down to brass tacks. What's a name or two that stands out to you right now? It's kind of a poster child for the methodology.
Sure. So I mentioned about Japan. We're holding a lot of companies in Japan now. We are overweight, not excessively overweight. There's some really interesting stuff going on in Japan. So what's really notable is the Tokyo Stock Exchange is changing their rules. And they've drawn a line in the sand for companies saying, if you want to remain listed on the exchange, or actually they have different levels of exchange, if you don't want to get relegated to the lower level exchange where there's less volume and stock prices are usually lower and such, you have to hit a whole bunch of standards, most notably a lot of them having to do with the book values of the companies and how much return on equity they're providing, all these great shareholder-friendly types of metrics that we haven't seen in Japan in a long time. And so Japanese companies now, they have till, I think, spring of 2025 to meet these marks before they get put on probation. They're all scrambling to improve these numbers and improve these metrics. So, I mean, there's a lot of companies that we like over there. I think you really can't go wrong, but, Shinetsu, we like a lot of the chemical companies. Shinetsu Chemical has been a big position for us over the years, and it's been a great stock. They provide materials and supplies to a lot of different industries, but most notably a lot of stuff that supplies semiconductor industries. So great stock there, and it stands to still benefit even more from this movement towards more shareholder-friendly policies.
What makes you sell? What makes you give up on something that has worked? Is it more about faster horses someplace else, or is it more about that bottoms up, hey, the thesis that you liked that brought you there in the first place isn't working?
Yeah, so any individual stock in the portfolio is contributing two things to the portfolio. One, all these measures and criteria that we're focused on, all these sources of insight that are telling us that companies, the way management's behaving, how investors are behaving, the analyst data, all this is making us think, hey, this stock's going to beat the market. If those start to change, well, that's step one. The other thing is the stock is filling some sort of role within the portfolio from a risk management standpoint. Maybe it's the best stock we can find in the home builders area, or the best stock we can find in France, and something like that. There's some risk characteristics it's filling. So those are the two things. And so when a company isn't fulfilling both of those roles, then we'll have to start considering, well, is there another company that can actually fill both of those roles that we might make a substitution for? Or maybe we'll just lower the weights, like, well, not as exciting as it used to be, but still pretty good and fulfilling this risk role, which is allowing us to buy some more exciting companies over here. We'll move the weights around and massage that position until it really either improves or is removed from the portfolio.
Well, now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
And now, folks, it's sock it to me time.
That's right, and socking it to you now is Derek Izuel. He is Chief Investment Officer at Shelton Capital Management, Portfolio Manager for Shelton International Select Equity and Shelton Emerging Markets, sheltoncap.com. Quick and dirty, of course, is our lightning round. If you want to get involved, you need to send your name, your hometown, and the ticker symbols you're interested in to chuck@moneylifeshow.com. We will add it to our list and hope it gets into an interview soon. And we are going to add, I'll point out, kind of an interesting experiment at the end of this. We're kind of doing something that's never come up before in Quick and Dirty in all the years we've been doing it. But we're going to start with something that's pretty common, which is 2 requests from Richard in Chula Vista, California. The first is VMware. That's ticker VMW.
Yeah, so I wanted to point out this in just a bit of warning here. VMware is in the process of being acquired by Broadcom. There could be, it's going to wrap up here in the next few weeks. It's been a long, year-and-a-half long process for Broadcom to digest VMware. I don't think there's any arbitrage really left in this. If there is, it might be a little too complex for us to really get involved with. So I'm just saying, if you're buying VMware in a couple of weeks, you're going to have Broadcom. So make sure that it's Broadcom you want. Broadcom's a great, big, giant, blue-chip semiconductor company, but significantly different type of business overall than VMware.
And if there's no arbitrage left, that actually makes me think that if you held VMware, it's time to take your money out. You're sort of suggesting take your money out and reposition it, unless you want it, of course, in Broadcom, right?
That's correct. And I if I recall, and forgive me if I do get this wrong, I think it's like a cash plus stock deal. So if you hold VMware, you're going to get some Broadcom stock and some cash. But if you just want to say, okay, I'm not interested in Broadcom, then I would sell now. Yeah.
And now for the profit taking.
So it's a qualified sell there on VMware, VMW. Richard's other request is for MI Homes, MHO.
Right. So we do a lot of the domestic positions that we invest in for my team is mostly small caps, and MI Homes is a position that we do hold in one of our small cap strategies. It's not a mutual fund, so there's the disclosure is not as necessary as possible. But what we like about MI Homes and a lot of the other home builders is if we're getting to a top in the interest rate environment, which we saw a lot of signs of last week with both Fed comments plus most notably the employment report on Friday. That could change in the interest rates, and home builders stand to be one of those cyclical firms that could benefit from this shift in the macroeconomic environment. And MI Homes is one that we like here. A lot of our signals are positive on it, so we hold it in our small cap fund. And should we continue along these roads, these kinds of stocks, a small cap home builder like MI Homes could stand to be a beneficiary. And you can see last week, in the last couple of days, it popped up pretty nicely in response to those macroeconomic signals that we saw.
That's a buy on MHO, MI Homes.
There's no place like home.
Our next request comes from Ellen in Harbor Springs, Michigan, and is shared by Dan in Williston, Vermont, both wanting to know about Vishay Intertechnology. That's VSH.
Vishay is it's about a $3 billion market cap semiconductor company. So another domestic small cap, another one that we hold in our portfolio and are big fans of. One thing I've mentioned is that we like to look for sources of and data that comes from sources of insight. And what we've done at Shelton, we've built a tool that analyzes the transcripts of the conference calls every quarter that come out from these, all these companies issue. And we look at the language that's used by management, the CEO and the CFO, and we also look at the exchange between them and the analyst community, the question and answers that goes back, and what kind of sentiment you see in there, how much data they provide. And so, and also, what kind of language that they're using. And so from this, we've been able to figure out that there are certain patterns you can notice that tell you, this stock is actually likely to do well, or management might be hiding something, watch out. So they just had their reported, I believe it was last week, Fichet did, and we saw a lot of good signs in that conference call. We saw some good sentiment. We liked what we saw in the Q&A, both the questions that were asked, but also how management answered it. And so we're a big fan. We hold this position. We would stand to continue to hold it. And if we do get a bit of a cyclical rebound here, some of these more late stage cyclicals like semiconductors stand to get a bid. And so Vishay would be a good place to be.
So what he's saying is that he came away from last week's call thinking,
you are so good looking.
yep, that's a buy on,
I think that sums it up, Chuck.
on Vishay Intertechnology, VSH. David in Missoula, Montana wants to know about Sangamo Therapeutics. That's SGMO.
Yeah, so Sangamo, excuse my butchering the word there. Again, another stock we hold in our small cap strategy, and we've been adding to stocks in this area. This is a genetic, it's a biotechnical company focused on genetics. They have a product they call the zinc finger. It's very fascinating. But we've seen this sector really get beat up across the board. There are so many of these biotechs that have been just going down and really are a fraction of what their former valuations are. And again, the driving force here, which has just been a broken record type of pattern here, has been interest rates. If you think about a biotech, their profits are way in the future. And so when rates go up, those future profits get a lot more expensive to get to. So the stock price goes down. And so we're seeing the risk reward in a lot of these biotechs looking pretty attractive right now. And you're starting to see when one gets good news, you're getting a 30 to 40% pop out of it. Yet they don't have a lot farther to go down. So I do recommend Sangamo. Again, a lot of the data that we look at is positive for that particular company. But I would recommend sort of a more broad-based exposure to some of these biotechs because they're in a position where, again, if the interest rates are topping out, these stocks stand to do well just because they've underperformed so considerably over the last year or so.
So Sangamo Therapeutics, SGMO, sounds like the right answer. But however, in there,
Buyer beware, dude.
just a little bit of caution about making sure that you are properly diversified in that space. And last, we're doing something that kind of happened a little bit by accident. Now, if you listen to the show, we send a long list of tickers to our guests and they pick off the list. Well, Derek punched the tickers in to decide which ones he wanted to talk about and came back and he said he wanted to talk about EPR, but he identified it as Europris, which is a foreign stock. And it was not the stock that Rich in Orchard Beach, Maryland wanted to know about, which was EPR Properties. So Derek said, that's okay. Let's plug EPR Properties into the system. So we're getting his live evaluation basically on what he thinks of the stock now. So he's going to put his methods that he's talked about to what he just learned as he punched the stock in. EPR Properties, ticker EPR.
Well, just in case, Richard, you want to buy a Norwegian retailer, Europris is a good one to buy. But EPR Properties is it's a REIT, and it's REITs are such an interesting sector. Most of these REITs focus on something, and EPR focuses on movie theaters. So one might think, well, geez, why would that's so out now? But look, post COVID, they took their beating, and movie theaters have done better. And so EPR also, again, just had a conference call recently. And once again, we analyzed the transcript and loved what we saw and loved what the words they're using, the data that they're generating. And, this is another, I know it's broken record, but we're just in such an environment where interest rates are so important. REITs are another place where if rates are going to start softening a bit, then, REITs with the yield that they generate tend to do pretty well because the yields will usually remain constant. You're still getting your 5% as long as the stock price stays stable or whatever that yield might be. So there's a little bit of a bond substitute play with these REITs. And so I think EPR, with the combination of the data we're seeing and the macroeconomic environment, it's a good time to be in a position of a stock like that.
So it's a buy on EPR Properties. Again, acknowledging that Derek literally looked that up and ran it quickly as we knew we had this issue. And then, by the way, in there, a buy on Europris, the Norwegian company. It's NO:EPR if you're looking for the ticker on that.
Buy. Is that all you can think about?
And yeah, well, we like thinking about buys. Now we've got one more good buy to think about. It's where I say goodbye to Derek Izuel. But Derek, this was a pleasure. Thanks so much for helping us see it in real time too, the process. I look forward to chatting with you again down the line.
Thanks, Chuck. Always a pleasure.
Derek Izuel is Chief Investment Officer at Shelton Capital Management. SheltonCap.com. He's manager of the Shelton International Select Equity Fund, SISLX, and Shelton Emerging Markets, EMSLX. Again, SheltonCap.com for more information. And stick around, we'll put a bow on today's show right after this message.